You check your bank app at 11:43 p.m., lying on a secondhand mattress bought off Facebook Marketplace. The balance reads $12.47. That is not savings, it is your entire balance. You refresh at 11:44, nothing changes. You are 23 with $31,000 in student loans, $4,200 on a credit card, and a direct deposit already spent before it arrives. You tell yourself you are not behind, yet every grocery run turns into a silent calculation. You put the good olive oil back and choose the store brand. Share a streaming password with someone you no longer like. This is what zero feels like. Not dramatic, but a low, constant hum of arithmetic beneath every choice. You do not talk about money. Nobody does at this level. Still, everyone performs the same quiet math. You check your banking app more than your messages. You know your account number by heart. You move $200 to savings, then pull it back. At zero, money is not a tool. It is the air you breathe. Either you have enough, or you are suffocating, and sometimes you cannot tell which. The first rule is clear. At zero, your relationship with money is entirely emotional, and emotional decisions compound in the wrong direction. Small raise brings $6,000 a year before taxes, $387 extra monthly. You feel rich for one afternoon, and the car needs $900 in brakes. Expenses expand to fill any space you create. You pay off the smallest credit card $1,200. Screenshot the zero balance. You send it to no one. That screenshot means everything. The first time a number moved in the right direction because of your decision. At 26, you cross $10,000 in savings for the first time. You have never seen 5 figures? For a week, you check the balance constantly, not from anxiety, but disbelief. You leave it untouched, letting it sit as proof of possibility. The psychological weight feels heavier than the number itself. You sense you have entered a different category of person. You begin reading real books about how money moves. You learn about index funds. You open a brokerage account and stare at it for 3 weeks. The market dips the next day. You almost sell. You don't. In that moment, you choose. Fear will not run your decisions. You now earn $68,000 a year with $40,000 saved. You contribute to a Roth IRA. By most measures, you feel stable. You followed the rules. Max the 401k. Build an emergency fund. Avoid lifestyle inflation. Then one midnight, you run honest projections in a spreadsheet. 40 years of discipline yields a number that is fine, enough, but not what you want. This is the competence plateau. You are good at surviving. You are not yet good at building. The second rule hits hard. Salary is a ceiling dressed up as a floor. You start a side project on weekends. It earns $400 a month, then $900, then $1,700. You'd tell no one at your job. You'd reinvest everything for 14 months. You'd eat the same lunches and skip upgrades. Net worth crosses $80,000, then $110,000. You feel the gap between your path and where salary alone would lead. The gap holds leverage. Investments return $3,800 in a year while you sleep. Some months your side income exceeds your paycheck. You now understand an asset. Something you built that earns while you rest. Your sense of time changes. Every non-compounding hour feels wasted. At 32, you reach $150,000 in net worth. You own a rental with $44,000 equity, a brokerage at $61,000, and a business generating $6,200 monthly. You still drive the same car? You stay quiet about the numbers because discussing money at this level makes people envious. You begin saying no to automatic yeses. Destination weddings you cannot afford without selling assets. Group trips where you would subsidize others. Friends' ideas that ignore cash flow. Friction appears in relationships. You feel it and say no anyway. You stop spending to maintain connections. And start protecting capital for options. At $300,000, your money develops preferences. One investment gains $22,000 in 8 months. Another loses $9,400. You do not panic. You reposition. People at the bottom rarely understand that the top is not about avoiding risk, but choosing which risks to carry. The third rule emerges. Below 500,000 UBI assets. Above it, assets begin buying each other. You are 36 with 920,000. You have restructured the business twice, added a partner, exited one holding, and rolled proceeds into something larger. Sleep comes harder from intensity, not stress. You run scenarios in the shower and send emails at 5:30 a.m., You turn down a $2-100-10-1000 job offer because it does not feel right. Then on an ordinary Tuesday, the brokerage updates to $1,040,000. You expected more emotion. There's quiet satisfaction, then clarity. 1 million at 4% yields only $40,000 a year. That is not freedom, it is a starting point. The milestone was proof of concept. The fourth rule lands. Wealth is not what you accumulate. Wealth is what you no longer have to do. Stop attending startup meets and seminars. You no longer need them. You operate in smaller rooms with fewer people. At 2.3 million, money stops causing anxiety. It becomes a resource like time or attention. You focus on allocation. You hire then fire a wealth manager when you realize you know more. Your business reaches 4.1 million in revenue. You hold 2 rentals with 380,000 equity and a portfolio at 1.6 million. You are not rich in casual conversation. You are wealthy in time. You take a 3-week trip and ignore email for 5 days. That freedom is unavailable at lower levels. 5 million, the game shifts from building to positioning. You move capital rather than earn it. You enter deals expected to return 800,000 in 18 months. And others that may return nothing, because correlation is the real edge. You spend time with people at 20 and 50 million. You study their longer patience and focus on staying at the table. You stop talking money with those who lack it. Conversations become imprecise. At this level, 500,000 is merely a position size. You reach 14 million and enter rooms once reserved for reading, family offices, and private equity platforms. You sit because your capital and pattern recognition add value. At 10 million, your reputation becomes a financial instrument, earning returns on its own. You face choices once morally complicated. A portfolio company lays off 140 people. You know the CFO, but do not call. You review the cap table and hold. The position gains value. You notice the widening distance between decisions and consequences, but do not resist it. Net worth crosses 30 million at 54. Trusts and a foundation costing 800,000 yearly are in place. You give more, not for show, but because money no longer measures you, and giving still feels like a real choice. Above 50 million, money stops measuring worth and starts measuring reach. You are 61 with 94 million. The exact figure is known to 3 people. You have not held a conventional job in 9 years, yet never stopped working. You think in long cycles, demographic infrastructure, creditan position ahead like a sailor reading weather. In a board meeting with 5 people whose combined capital could reshape an economy, you speak for minutes and ask 2 questions. The room moves around them. Power is quiet and precise. Somewhere right now, a 24-year-old opens his banking app. The balance is $12.47. He stands in a grocery line doing the same math. He puts the good coffee back for the store brand. He believes more money will resolve everything. He does not yet know the real cost is measured in distance, the gap between who you start as and who you must become. The machine does not ask if you are ready. It opens every morning for whoever shows up consistently, without flinching. Those who persist compound. The money compounds, and so does everything else. The balance is still $12.47. It always starts there. It always will.